Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me today for our market briefing and to weigh in on the top stories of the day is Tai Wong, independent proprietary trader. Tai, good morning, and thank you for joining me today.
Oh, good morning. It's another nice day out here, and it's National Fluffernutter Day. Did you like Fluffernutter when you were growing up?
So for those of you who don't know, Tai will tell you what a fluffernutter is.
So fluffernutter is a sandwich made by marshmallow fluff and peanut butter, and there's big parts of this country who really, really like it. Sounds a little strange. Personally, I'm a peanut butter and jelly man, but fluffernutter is it's a good, it's a cute sandwich.
It is, and if you think about it, I believe most people might be familiar with peanut butter in a jar, but the concept of marshmallow fluff in a jar, that might be a little foreign.
Yeah, it's a little strange. Sounds very processed, but every once in a while, like, give it to your kids. They'll like it, and then you can blame me for having a lot of refined sugar.
Well, it is a American treat, and it is something that you might want to try once in a while when you have a hankering for something like that.
Yeah. And if you're not a fluffernutter fan, it's also National Salmon Day. So salmon is always like the popular sort of fish for when you're entertaining, because it's easy to cook and pretty. Yeah, nobody gets offended by it. So it's a good day. It's a foodie kind of day today.
And speaking of which, we are keeping our appetites up today, and we are seeing the market higher as well. But this does come after the sell-off we saw in the previous session, where the Dow fell by nearly 400 points. So let's dive into the topics that are dominating the headlines. And I think a good place to start today will be in China, since they have come back from their holiday, and there are some expectations overnight, weren't there?
There were, and just as a little bit of a precursor, they knew, I think the Chinese authorities and the Chinese banks and brokers knew that they closed a week ago in the middle of one of the biggest rallies they've seen in probably in a decade or so. And they knew that I think we talked about on the show, the animal spirits, at least on the trading side, have really been woken up. That people are looking to borrow as much money as they can to invest in the stock market, when now all of a sudden they see lots of opportunity. As a matter of fact, on on Monday, which was still a holiday in China, a lot of banks and brokerages and the exchanges were actually open to test all their systems, which is really smart, because they knew that there'd be a crush. They didn't want things falling over. So really kudos for thinking about that. The Hong Kong Monetary Authority actually reported huge borrowings from their discount window over the past couple of days, because there were so many people trying to withdraw funds to put into trading accounts that they needed just to go to the discount window to just get some liquidity. Not like they were in distress, but it indicates how many people were really into it. So the big so they come back to yesterday, and at 10 o'clock we talked about it. They had, they had the policymakers had this press conference, and the summation from Bloomberg, the National Development and Reform Commission. They said Chinese officials said they were confident of reaching its economic targets this year, and promised further support for growth, although they held back from unleashing more stimulus. And the market sort of went, oh.
I know, there was disappointment overnight because expectations were so high.
Was so high. And it's sort of, oh, we're going to hit our 5% target today. And most of the market goes, yeah. Half the market thinks, it's an artificial number. And I don't even want to get into that, whether they actually are growing by 5%. But that's not what the market's worried about. The market's worried about the direction of this really, really big boat. And this really big boat, I don't want to bring the Titanic, into it, but a big boat that has a small rudder and is actually really hard to steer. And they really wanted a lot of stimulus, and they didn't get it. Now, this morning, Evercore came out and said they think that the Chinese are holding some dry powder for stimulus in case Donald Trump wins, and he comes out and rails against China and puts on bigger tariffs, and they'll need that additional push. interesting and it'll get some headlines and hey, we're talking about
Sure.
it, right?
Yeah.
I'm not sure
Absolutely.
that's true, but
Mhm.
let's take a look at let's look at graphic one, um, which is an amazing chart. So if you look at let's look at the left side of the chart. That's the benchmark the Chinese benchmark, and so the I pointed to the green bar, which was September 30th, and then October 8th, which is when they opened today overseas, they this a huge red bar after a lot of green bars. I rarely do you ever see a chart like this, and what it says is it opened on the highs, and then
Mhm.
that sort of disappointing press conference came
Yeah.
out, and it actually, when I was watching this around 11 o'clock last night, it was a bigger red bar, and so it opened high and collapsed, probably 10, 12%, and then rallied a little bit in the late afternoon session. This is a very, very unusual chart where you get, does this say this is going to be the top for a while?
Mhm.
It might signal that, really. And then on the right hand side is the Hang Seng, and the Hang Seng, you can see that the Hang Seng dropped 9.5% yesterday. Um, that's You can see that red bar is the Hang Seng drop, and they dropped because they were actually anticipating where the Chinese stocks were going to open, and the Chinese stocks actually opened and then dropped much lower. So that's why you see that big drop in the Hang Seng. Very unusual charts. They're going to be watching this for quite some time, and I just thought it was worth showing to you.
Yeah, and Ty, I'm glad you brought up this chart because when we woke up this morning to look at markets overseas, we saw that difference, right? When it comes to the losses for the Hang Seng versus the Chinese index, that was quite a difference heading into today's session. And of course, as you mentioned, it came on the heels of the disappointment because expectations were high that we would get something from the Chinese government.
Yeah, I think they do need something to really. We're going to change. I think they're going to have to make adjustments to the economy fundamentally to
Hmm.
get them out of this funk. And the trouble with an authoritarian regime is people don't necessarily always tell you what you need to hear. So you sort of have to experience the pain and the yelling and why what the standing committee may be asking in a week's time, why are the markets down? And they'll be like, well, they were expecting a little bit more, and that's
Hmm.
how I think messages get across, where you don't have the freedom of speech and that democracies and much of the West have, and it's loud and it's messy, but messages get across a lot faster, and your advisors may tell you things that you don't want to hear, and I think in an authoritarian regime, I think Putin actually, just a sidebar. Putin was a victim of that when he invaded Ukraine. He thought he'd be walking in Kiev in a week, and it's been 2.5 years. It's been terrible for both sides in terms of casualties and human losses. But he didn't get good advice, and we'll wait to see if the Chinese government gets good advice in terms of their economy. On that note, actually, I want to show a couple other graphics. Let's go to graphic 2. And this is from a guy named Brent Donnelly. I heard him speak, and I get the free version of his newsletter. And he runs a newsletter, Spectrum Markets, and he had something the other day that I thought was really, really insightful. So this is a quick look at the Western stock markets, the Nasdaq, the DAX, the Toronto Stock Exchange, and the FTSE for the last 12 years or so. And you can see, there are blips and dips, but generally they all have an upward drift. So they all rally over time. The Nasdaq, probably the best of all of them. You could argue that that's because American tech is so good. So just remember this chart, upward drift over time. So let's go to graphic number 3. And you'll see this is the Shanghai composite from 2011 till now. And Brent compares it to, whereas instead of the Western stocks, these actually look like meme stocks. And you can see Dogecoin, and you can see, I think it's GME on the right hand side. That you get a big spike, and then they kind of drift along, and doesn't do much. You get a spike, and they don't do much. But what's important is you don't get that upward drift. And I
Hmm.
think this is directly, and you actually see something very similar in the Hang Seng as
Hmm.
well. If we look, I didn't bring up a chart, but when you have sort of a lot of freedom in the economy, people can invest in what they want to invest in, and companies can make investments without worrying about the government, without the government saying, "Oh no, you can't do this." Alibaba, you cannot be a financial company. That Ant thing was supposed to be their big financial move, and they could be, like a big bank or a credit card company, and that got squashed. When you squash those types of animal spirits, that's what you get when they don't have a natural upward drift, which you should in a stock market, because inflation and prices go higher, so your stock market should go up over time, all things being equal. We don't see that in China. So it's something that really worth thinking about, where it's a different government regime, and it makes a difference over the long term. Early innings yet. Don't discount the ability of the Chinese government to do something dramatic if they need to, but they're going to need a little bit more than what they've shown so far, is what the markets are telling us right now.
And I think it was a good contrast to see the differences between those charts that you presented. And you're right, when it comes to concerns about the bigger picture, when it comes to the Chinese economy, there's still concerns on the heels of the stimulus measures and other measures that were announced last week as we head into the rest of this year. So we'll have to keep an eye on what happens, and if there are any measures that come out as we move forward.
The Politburo meets again in October. They may even have another December meeting. And if they think they need it, if they're convinced they need it, they will do something. But are the messages getting through? And I think the stock markets in the Far East are going to be very volatile. There'll be a blurb of a good news, and it'll rally a couple percent, and then it'll get disappointed. It might retrace 3%. I expect a lot of volatility as the market tries to sort this out.
And speaking of volatility, I think it'll be a good moment to do a quick market check, especially on the heels of some of the pullback we saw in the equity averages yesterday. So this morning in New York morning trade, we did open higher. We saw the Dow Jones Industrial Average dip slightly below the flat line, but right now we are above the flat line, up by about 30 points on the session. And this does come on the heels of that rally to record highs we saw at the end of last week. Now, in terms of the NASDAQ Composite Index this morning, it is higher after closing lower yesterday. It is up by over 200 points and up by 1%. So we'll take a look at some of those Mag 7 names today, because we did see a sell-off in the previous session. And of course, the S&P 500, let's take a look to see where we are this morning. It is higher by about 0.7% this morning. So, Tai, given that we saw that pullback in U.S. stocks yesterday and the rise in yields, we saw the 10-year yield above 4%. Right. It is still holding above those levels. So what do you make of the price action we saw in stocks as well as bonds and, of course, crude oil?
So starting with stocks, I think what contributed to the late sell-off yesterday was, I think it came out maybe a little bit afternoon, that a federal judge put an injunction on what Google could do. And that's because they lost an antitrust case against Epic Games. I think it was they're not allowed, they had to make the App Store, their App Store, Play Store, I should say, accessible to other developers, so they could develop things that to compete. They could no longer pay developers extra to only show stuff on the Play Store, and I think there might have been one other thing, and they couldn't prevent device manufacturers from putting on somebody else's Play Store, and these remedies are on for 3 years. And that hurt. Google made, I think, $12 billion or whatever it was from their App Store last year. So this is going to hit them a little. This is going to hit them, a bit for sure. And it certainly hurt the mood in Google. I think it hurt the mood for the stocks in general, because they're one of the Mag 7. Plus the uncertainty that we had yesterday, still trying to figure out where the Fed is after that big blow-off report on payrolls report on Friday. So in terms of, so I think we're bouncing back a little bit today. But Google's one of those things where sometimes, and like Apple, you can be a leader and a winner, but maybe leave a little room for the competition, so the Department of Justice and the antitrust folks and don't get into your business as much. So leave a little room for the competition. It seems to be maybe the best advice, but I guess when you're the leader, you want to keep, you want to make sure you stay the monopoly leader as long as you can. But to your question about crude
Yeah.
has had, and this is in part related, I think heavily related to the disappointment in China. Crude's had a 3 or 4% pullback today. It's the biggest pullback we've had since the Iran ballistic missile strike on Israel.
Yes.
We are still waiting on Israel's response. Don't know what's going to be, don't know if it's going to be military, the oil field, or nuclear. And I think crude probably shouldn't be this high given where demand fundamentals are, and especially if China disappoints, that's an automatic reaction, take a little profit in crude oil. I think it remains elevated until we see the results of what Israel is going to do. In the meantime, they're attacking the Gaza Strip again. Hezbollah is still getting hit. I think Hezbollah seems to suggest that they may want peace because the leader who was killed, I think, was also killed, and at some point you no longer want to raise your hands to be a leader if you just keep getting targeted. So we're seeing a pullback in crude, and I think that's actually also affecting gold. Gold has been under some pressure, down about $60 over the last couple of days. Silver getting hit pretty hard as well. I would also add that it just came out the other day that the People's Bank of China, for the 5th straight month, did not buy any more gold. And they were instrumental in driving gold up here. So the last time they bought gold was in April, and the price around there was, I think, about $2,280 an ounce. So I would think that we probably have to get back below 2,300 or so before the People's Bank of China decides to add. Now, I don't think we're going to get down there in this correction, and gold doesn't have the feel that it's going to collapse. It really doesn't. Now, if we get a very perky CPI number, and you get Fed speakers coming out and saying, we might have to rethink if we have to move in November, that may be enough of a trigger. But right now, I don't think we're going to get down there. So I think the Chinese are going to remain relatively quiet. Maybe we have a short-term high in gold, but the sentiment is still very good. It's still sort of a bull market. One thing I would add is we talked about buying platinum at Costco. I haven't checked the prices recently, but platinum has dropped fairly, probably $50 or $60 since we last talked about it. And I would think that Costco really, the way they work is if prices of their goods come down, they'll they'll take the prices down for the consumer as well. So they were out of platinum bars last time. I'll have to check after the show if they're still around, maybe a little bit cheaper.
And we're starting to see some headlines about how gold bars at Costco are selling out given the run higher for gold. But as you mentioned, when it comes to central bank buying of gold, this is something that Tai has spoken about, and if you want to learn more about it, you can actually go to one of Tai's market insights on gold. But when you think about how much gold has risen this year, the value of central bank holdings is higher just given this value increase.
At least 30% higher if you didn't add to it in the middle from last year, because gold's up almost 30%. It's a phenomenal move. But it's a move, it's a single commodity. Single commodities can really roof. I mean, my favorite example is silver, which went to 50 in 2011, and parked there for, I think, even less than a day. I'm not sure it even closed above 50. Was down below 40 a few days later, and then we haven't seen it back at 40 in years. So it's a great year for gold. Is it going to be a great year for gold next year? Kind of hard to say, but right now I think you can be long or flat. It's tough to be short right now. I think if you sell gold right here, it's because you're long and you want to take a little profit. Or if you're a scalper and you'd say, oh, I want to sell it here and try to buy for $10 lower, which we call people who try to get a little bit of money in the market, and there's room for that. And they add to liquidity and the programs who do that, and it's all good, but this is still a bull market.
And because we mentioned Costco, I do want to shift our focus on what's happening in the southeast of this country, in particular down in Florida. So Hurricane Milton, since we last spoke yesterday, it strengthened into Category 5. It is currently a Category 4, but it is forecast to make landfall in Florida. So expectations for this storm are detrimental for the residents who are living on the west coast of Florida. What do you make of what we're seeing as we head into the rest of this week, Tai, and what are your concerns?
So, one thing that I realized over the last 24 hours is I am a terrible meteorologist. I think it was yesterday that I talked about Milton. It's a small but powerful storm, and it's not as big and as troublesome as Helene, and it'll hit Tampa probably and cut across Florida. It won't be awful. Well, that storm strengthened unbelievably in about 16 hours. It went from a category, I think it might have a category 2 to a category 5, and there's suggestions that before it hits Florida, it'll strengthen again to the top of the category 5 area, which is 192 miles per hour winds, and some people are talking about a category 6. So hopefully it weakens and it's not as terrible. But right now it looks like a really big storm headed straight for Tampa, which has a lot of expensive real estate, a lot of people, and then it's going to cut right across Florida, go over Orlando, which is our support team is in Orlando. So hopefully you guys take care of yourselves and God, you do what you got to do. But I think the mayor of Tampa said, listen, if you are, and she said it very plain, which is great. If you are told to evacuate and you don't, you're gonna die. And they told people once again, use Sharpie. If you're not gonna evacuate, use Sharpies to write your name and identifying information on your arm so we can identify the body. So Florida, I think a lot of people are evacuating, because they've seen hurricanes before, unlike, poor North Carolinians never saw it really coming. But Florida's seen this before, but it's going to be very, very significant. And I think over time, it's going to accelerate. We've had a big migration into the southeast over the years, particularly Florida. But now you've got to think, if you're a Floridian or if you're thinking about going down there, wow, a lot of storms, a lot of flood damage. Can we, insurance is high and going higher. Is this going to blunt the migration into at least Florida? You'd have to think that on the margin, if you're going to retire, you're going to say, am I better off in Georgia? Am I better off in South Carolina, where we don't get these monster storms that could, maybe unlikely, but if they hit, they'll wipe you out.
Yeah, and there are a lot of concerns for the southeast as well as Florida ahead of this hurricane. And as you mentioned, the southeast is still trying to recover from Hurricane Helene that hit the region very recently. And it's very interesting because we have less than 30 days until the presidential election to see how some of the conversation has become political, what's going wrong in terms of government support, government aid in particular when it comes to FEMA. So, when it comes to natural disasters, we know that evacuations are important if you do get a warning ahead of time. But of course, it's very interesting to see how political this issue has become when it comes to recovery.
I guess it's inescapable because we're in the middle of a political season, and it's angry and aggressive, and people are divided and polarized. If you remember in 2005, the response to Hurricane Katrina, or the suggested lack of it, which I think was probably not correct and not accurate, destroyed George Bush's administration. He was a lame duck after the fall of 2005 and Katrina hit. And now you're getting people who they call it the redneck Air Force, which is just flying helicopters in and out of North Carolina because the FEMA can't get there. So will it matter? And we looked at the election yesterday. It's super duper close. It may well matter, and maybe it'll hit in ways that we don't know. Whether you get fewer voters in Florida or fewer voters in North Carolina. Can people actually vote there? And they're already making, like in North Carolina, they're saying you can vote outside of your county now because some counties are just wiped out.
Well, we will continue to monitor the hurricane as well as the markets when we return tomorrow. But now Tai will be taking my seat, and after the break, Tai will be joined by Danielle DiMartino Booth, the CEO and Chief Strategist at QI Research. So don't go away. I'll go have a peanut butter sandwich. So good luck, Tai.
Enjoy.
Thank you.
Welcome back to Global Money Talk, live from the New York Stock Exchange. I'm joined by Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Danielle, thank you so much for joining us today.
It's great to be here. I'm so excited to have a nice, in-depth conversation at the New York Stock Exchange. This will be a first for me.
Oh, and I have so many questions. I'd love to get your insights, watch a lot of your talks and your videos. So, I'd like to start. Actually, we've got this huge payrolls number on Friday, and it really turned the market on its head. The bond market slaughtered, the stock market actually rather liked it, and when half the market, or more than half the market, were thinking about 50 basis points, now some are even talking about should they have cut it all.
Right. There's definitely been a marked shift in the mindset, and this has really been a global non-farm payrolls report. We've seen ripples throughout the world. For one example, the British bond market moved even more than that of the United States. There was clearly a lot of positioning for a one-sided report. So when we saw that great big 254,000 headline, a lot of people had to completely reverse where they were and ask themselves more than anything else, was I thinking about the U.S. economy in the wrong way? But there are a lot of details in the report that suggest that Chair Powell and others on the Federal Open Market Committee on the September the 18th meeting were actually thinking the right way about that larger than expected initial rate cut that was predicated on weakness in consumption as reported by all 12 Federal Reserve districts across the United States, which was a highly unusual thing to see headed into the FOMC, and that's why Chair Powell mentioned the Beige Book. And the reason I bring up that detail is because once you started digging beneath the headline, you did indeed see that a lot of the jobs that have been created, in fact have been created for all of 2024, are some of the lowest paying jobs. And that helps to explain some of the stress that we're seeing in the consumer sector despite splashy big headlines in terms of job creation.
Now, if you just opine really quickly, the revisions were a little bit of a surprise. We saw revisions higher for the last 2 months for the first time in many months. Is that significant, or is there a story behind that?
Well, there's always a story. There's always a story behind every number, and that's kind of our focus at QI Research, is we're always trying to dig beneath the headlines. And in fact, in July of 2023, we had a similar kind of rippling in the market, because instead of the string of constant negative revisions, we saw a positive revision in July of 2023. What was behind that revision was that more than all of the revisions were attributable to government jobs created. That's exactly what we saw in August of 2024. So in July of 2023, we actually had a negative revision to private sector payrolls. Identical setup in August of 2024. More than all of the positive revisions in August were attributable to the government sector. And we actually saw, again, negative private sector revisions. So sometimes it really helps to pay attention to the details, because it's telling you that when we have a situation like PepsiCo coming out of the gate early on in this earnings season and saying we're still seeing a very selective, choosy consumer who's having to be very price conscious, that's because the private sector continues to shed jobs.
Well, that changes the complexion certainly a little bit. And I wanted to ask, because the market, as long as I've been in the market, focuses on this payroll number to almost the exclusion of everything else. Not the exclusion, but really it's the number of all numbers, and you said international as well. And I guess that may be a little unfair, but do you have a favorite indicator, or the indicator that you always look at, for that it might be a little, or maybe one or two of them that tells you something about the economy that most people who just watch the news won't see?
So there are two main elements of the non-farm payroll report that we pay the closest attention to. The first, which I'm going to go to second, is the types of jobs being created. But we have a mantra at QI Research: hours before bodies. Hours before bodies. When you see a 34.2-hour work week, you stop in your tracks and you say, wait a minute, those are hours being cut before actual layoffs, before actual bodies being cut out of the workforce of any given employer. And again, to see a 34.2, there's a 14-year low that we saw in this last payroll report. That's extraordinary. And the idea of labor hoarding, because it was so difficult after the pandemic came and then the economy reopened, and these were very much technical factors that affected the ability to rehire the best workers. And of course, you want those best workers. So you're seeing a reluctance among companies to reduce their headcount, but what they're doing instead, as demand slows, as household bankruptcies rise, as corporate bankruptcies rise, what we're seeing instead of headcount reduction as an initial step, because it was so difficult to acquire those employees after the economy reopened, is hours being cut. So we said, wow, 14-year low in the work week, next step, headcount reduction.
That's great, because nobody ever talks about that. It's sort of like a throwaway line. Oh, an hour's work. Well, I've never actually heard in 30 years in the market, even an economist, talk about hours worked in again, an interesting way. So at 34.2 is a little low. Where would you like to see that suggests a more healthy economy?
Well,
roughly?
I think at 34.4, 34.5,
Okay.
those, and it may sound like a very small movement, but when it comes to what makes the U.S. economy hum, what makes the driver of the U.S. economy is aggregate income.
Right.
It's the number of hours worked times the number of individuals working. So when you're talking about a 34.2-hour work week, the aggregate income destroyed, and that's how you have to look at this, is tremendous.
Interesting.
And that actually can equate to a certain number of jobs that were actually cut when hours are cut enough across the entire massive U.S. workforce. So that's the first thing that we look at very, very closely.
Have you ever seen that at 35 or 36? Does it ever get up that high?
Absolutely. When you had companies unable to hire sufficient numbers of workers, they were working their workers harder. People work. It's the old-fashioned overtime.
Right.
Overtime refers to a really elongated, higher work week. And that's because you don't have enough employees on hand, so you're asking the employees who you do have working for you to work longer, work more hours in order to be able to satisfy the demand. That's why one of the other things, if I can digress for 2 seconds, that we follow closely are backlogs. We're looking for backlogs, whether it's a law firm in services backlog. And boy, I've got requests to do work that I simply don't have the manpower, the woman power to complete. So my backlogs are growing. That's an indication of future demand for labor.
And do we
Same
see
with
that
the
in the
manufacturing
employment report as well?
We had seen backlogs that were very positive. Now we've seen a string of weak backlogs in services and in the manufacturing sector, both, that we haven't seen in a long time. That's why it was such a big surprise to a lot of people on Wall Street to see the fact that we had this strong non-farm payroll headline, but at the same time, whether you're talking about the ISM non-manufacturing, the ISM manufacturing, S&P Global Manufacturing, S&P Global Services, all four of those employment indices in reports that preceded non-farm payrolls showed contracting employment indexes.
Right.
And that shows that's a reflection of negative backlogs. The fact that you actually have more workers on hand than you need because your backlogs have turned negative. So we've seen a real flip in that dynamic. And that goes to the second element that we follow so closely in the non-farm payroll report, and that is the types of jobs created. In the month of September and August and July and June and May and April and March and February and January.
Like a pattern.
Like a pattern. What I used to tell when my children were younger, do you detect a pattern? We've seen 50% or more of the jobs created be in education and healthcare. So I ask you, I'll be Socratic for a moment.
Sure.
Does it matter what's happening in the economy, or do you still need to go to the doctor, and do your children still go to school?
Right, right.
So we call education and healthcare recession-proof industries. They're going to continue to grow their payrolls regardless of what's happening at PepsiCo and people not buying Tostitos because they're going down and substituting for a store brand. So those recession-proof industries, the fact that they're creating and have been for all of 2024 more than 50% of the jobs is not a sign of strength.
They're both education and healthcare are really, really important, but it's not really economic growth.
Exactly.
They don't draw. They're not really engines of economic growth.
They're not.
At least not immediately.
No, and that's why we have to study so closely the makeup of the jobs. And in fact, when you look at prior recessions, you actually see private payrolls begin to turn negative in the face of continued growth in education and healthcare, because we're always going to get sick. And I think we discussed before coming on it, we both have 4 children, so we're always going to send our children to school.
That's absolutely right.
But that's why we call them recession-proof.
So we should actually have, non-farm forget non-farm payrolls ex education and healthcare. Let's have that. Let's look at that number. That'd be maybe a better number to look at.
It is, and there was a time, for example, in the high yield credit market, that we got so used to saying X energy. Well, you say to yourself, if you net everything out, then what are you really even looking at? You're simply making economic data convenient to fit your own narrative. That's simply not the case when it comes to education and healthcare jobs, because they genuinely are basic needs. These are industries that are going to have job creation regardless of what economic output is in the aggregate, which is gross domestic product defined.
Right. That's really, really good insight. I want to switch gears a little bit because I know our viewers want to hear, and this is a really tough one, in a very, very closely divided electorate and election. What does it mean for the economy and or markets between if Vice President Harris wins versus where if former President Trump wins? Like, where are we going to see, if you were an investor, where are you looking at? What should you be thinking about?
So, it's interesting. We just had fresh data out from the National Federation of Independent Business, and their uncertainty index rose to the highest level on record because the outcome of this election is so economically, vitally important to this economy. We forget that in a post-pandemic world, there were emergency unemployment benefits that applied to gig workers and the self-employed. There was a rental eviction moratorium for 19 months nationwide that paid for your rent, which is your largest line item as a household. But what I'm describing is fiscal policy. And fiscal policy is critically important. Is there going to be spending in the defense sector? Is there going to be more support for overseas wars? Is there going to be more funneled into U.S. industry? Is there going to be more onshoring? What are the initiatives? How are tariffs going to affect the economy? What type of social spending is going to occur? What kind of funding is FEMA going to have? Gee, that's on everybody's minds these days. But it all comes down to the makeup of fiscal policy. And that is why there is such hyper-focus on the fact that the polls, in most cases right now, are so evenly divided. We really are going into Election Day with a complete unknown as to the outcome. I will tell you, though, that there is a very high degree of certainty, judging from what the punditry says. There is a high degree of certainty that the U.S. Senate is going to flip back into the hands of the GOP, into the hands of the Republicans. And that's when you get back to Civics 101, U.S. History 101, and the very idea of checks and balances. In December of 2020, to give you but one example, then President Trump was asking of Congress for a second stimulus check in the amount of $2,000. At the time, there was a Republican-led Senate that capped that second stimulus check at $600. So it was much less additive to the deficit at the time. It was much less additive to consumer spending at the time, because instead of getting $2,000 directly deposited into your checking account, you only got $600 that you could pump directly into the economy. And that is where the outcome, I think, of the congressional elections in the United States is so much more critical to the fiscal policy that we're going to be looking at least for the 2 years that follow the election into the midterm elections.
Sure.
And that is indeed what politics in America has become. We've become a 2-year election cycle country, and it's just a fact of life.
It's almost, it's for the House at least, maybe it's too often. Every 2 years you're legislating for a year and you're spending a year on your re-election. But to your point, but I've seen, I guess, the Republicans can snatch defeat out of the jaws of victory better than anybody. I think we've seen the 2022 red wave became barely a red ripple. So let's say, counterfactually, that Vice President Harris wins, and she gets a 50-50 in the Senate, which means Tim Walz would cast a tie-breaking vote, and the Democrats take the House, which seems to be sort of
that seems to be your base case right now, is that the Democrats take the House. So that is correct. And so you could paint a scenario where there was a blue wave. And boy, the implications are tremendous.
So where do you see for the markets and for the economy?
Some very good economists at AEI, for example, they've done very simple back-of-the-envelope math on what it would be like to give 4 million U.S. first-time home buyers a $25,000 credit to buy a home. So it would cost taxpayers somewhere in the neighborhood of about $100 billion. It would add to home prices by about $175 billion. I think 92% of economists, which means it's a bipartisan agreement in the economics community, say that that would be a very bad thing for U.S. housing policy, because it would actually make home prices increase more than the benefit that would be provided to home buyers. And that's just one example. You think about the idea of helping to pay for education, or more student loan relief, or something along the lines of a universal basic income, a modern monetary theory. There are a lot of social spending programs where you would open the pathway to being very much more giving as an electorate, more socialist leaning in terms of how fiscal policy is shaped in the event of a blue wave. From an investor's perspective, what we would say, and I'm going to use shorthand here, is short every U.S. Treasury if that's the case. Because if you think that you've seen fiscal spending gone wild with more of a balanced backdrop in Washington, D.C., just you wait until, and by the way, wait until either party had control of the White House and both houses of Congress, and therefore a blank check, carte blanche, the ability to have whatever kind of spending in whatever form that they wanted for it to be.
Right.
So that is not the base case on Wall Street right now. I think that there would be a lot more alarm if that was the case. And in fact, most of the people I speak to, because if you look at deficit spending under President Trump and you look at deficit spending under President Biden, they're pretty close to one another.
Yeah.
So I think that it is much more a matter of whether or not the Senate flips back to being Republican to stop overspending by either potential occupant of the White House. I think that most investors are agnostic in purely a dollars and cents sense. I think that they're somewhat agnostic to who wins the White House and much more focused on whether that check and balance is going to be in place after Election Day with a red Senate.
That's great insight. I think that's absolutely true, and I think Americans don't take their civics, seriously enough. And as you say, in terms of the social spending, if there's a blue wave, if you rob Peter to pay Paul, you're pretty much guaranteed the support of Paul.
Yes.
And that's, I think, the base of a lot of politics. So,
I lived in the country of Venezuela, which is something I rarely talk about, but I did. I lived in Venezuela for a very long summer, and it was prior to Chavez coming to power. There was a massive income inequality divide at the time, in much the same way that there is in the United States right now, and therefore there was a groundswell of support for major fiscal spending programs, but you come to find out more than a decade later, somebody's got to pay for it.
Look what it has wrought to Venezuela. So it sounds like maybe if we get the divided government, whoever is the president, we can maybe just stick our money in the S&P 500 and sort of let it ride. Whereas maybe we'll buy home builders if there's a blue wave, maybe. I want to shift a little bit because you were earlier in your career, you were with the Fed a long time. I think you might have some special insights on the Fed. I'm not asking for any proprietary or embarrassing information, but really, your thoughts on. First question is, does Jay Powell ever worry that if he lets inflation take hold and go maybe a second time, that he's going to be Arthur Burns #2? We remember Arthur Burns only, the 1970s Fed chair, only because he let inflation really get out of control. Does that ever intrude into Powell's mind, like, for this job, I don't want to remember badly, half a century from now?
Well, he certainly has been very vocal in saying, Paul Volcker is my hero. Two speeches ago at Jackson Hole, in fact, he mentioned Paul Volcker multiple times. And so you certainly see that he does not want for his legacy to be anything like that of Arthur Burns, because his hero is Paul Volcker. And Paul Volcker broke the back of inflation, famously.
Right.
So, but when you actually plot out Jay Powell's higher for longer campaign, and you compare that on a very simple time continuum with that of Paul Volcker, Jay Powell was higher for longer at a higher level and for longer than Paul Volcker was.
Wow. Didn't realize that.
And we don't appreciate how very long he held the line, even when there were signs that the labor market was weakening. So I think what concerns me more, because I'm hawkish in nature. Mm-hmm. What concerns me more is that there are very few people who are like-minded to Jay Powell, and we don't appreciate how soon May of 2026 is going to arrive.
Right.
It really is just around the corner when he is no longer going to be, I don't think he would take a third term, and I don't know that he would have support to be offered a third term. So under the assumption that May of 2026 is indeed when his term ends and when he steps down, one of my concerns is that when Vice President Harris was the swing voter in the Senate, there were quite a few progressives who were confirmed by the Senate, Lisa Cook being one of them, with the swing vote of Kamala Harris to become confirmed to the Federal Reserve Board. And so one of my longer running concerns is that elements such as climate change or a central bank digital currency, which frightens a lot of individuals. They look at it as being a mechanism by which the government can track your spending and see your spending, which is kind of very un-American, if you will. But there are a lot of progressives with long terms who are on the Federal Reserve Board who could be instrumental in shifting the U.S. economy to being much more progressive in nature through the mechanism of monetary policy making.
That's really interesting. But I want to get back to some of the new governors, because there's a kind of cypress tree. But before I forget, where do you think the neutral rate is now, give or take? And which way is it going?
Well, I think it's very hard to pinpoint the neutral rate. I think that where most who contribute to the dot plots want for it to be has been inching down. It was 3.1% 2 dot plots ago. Now I believe it's 2.9%. What I will say about the neutral rate is I want for them to be right. I do not want to go back to zero interest rate policy. I think it was failed. I think that it ignited the wrong kind of speculation, and I think that it made price discovery that much more difficult for rational investors who want to consider risk and return, as opposed to just, I'll take, risk doesn't matter because the Fed's going to have my back in a zero interest rate environment, or there'll always be quantitative easing coming to the rescue, and ergo, neutral's irrelevant. I want for the dot plot to be correct in the long term. The terminal rate, I want to be something with a 2 in front of it,
Okay.
and not to go back down to 0. And I'm very, very adamant about that.
Any concerns that sort of the green economy and going low carbon that will elevate the neutral rate because those things just cost more and are less efficient? At least they seem to be for now. Is that going to elevate the neutral rate over time if we want to use less efficient ways of doing things?
It certainly could. And in fact, there was a parallel discussion going on at the beginning of the pandemic when there weren't enough masks in the United States, for example. And so there was this big discussion. Do we accept higher inflation in the long run in order to onshore critical industries that are matters of national security? And you're asking a parallel question to that. And I'd like to think that capitalism itself finds the most efficient way to price and produce. And if that's the case, we hopefully don't buy into a higher neutral rate long term. But again, there are definitely exceptions, and the patriot in me is not in any way, shape, or form disappointed to see an effort towards bringing more manufacturing back to U.S. shores, and or simply building a tighter supply chain with Canada and Mexico, which actually makes economic sense when
Right,
you factor
sure,
in
sure.
something like, freight, which we talk about quite often, and supply chain disruptions and what can happen if there's a strike at the port. Whereas if you've got a tighter supply chain that's closer to home, it might end up raising what that inflation is ultimately, but to maybe an extent that we're all willing to accept in order to have a more secure supply chain going forward.
I think that's the right question. And very quickly, where do you think I remember learning about NAIRU, the non-accelerating inflation rate of unemployment. What do you think that ought to be? Where's the unemployment figure, that makes you happy and sleep well at night?
So I think we're learning in real time right now. I think that kind of the 4% area is where we're in safe ground. What we've seen once we've gotten past that 4% is the appearance of very low initial jobless claims. But we also have more part-time employment in the United States than we did at the peak of the Great Recession. So we have completely refilled our part-time job pool with just a very small movement up in the unemployment rate. And again, we're an aggregate income GDP economy. And if you're working multiple part-time jobs in order to make the same income that you did when you had one full-time job, that's not the sign of a balanced labor market.
Very, very good point. And before we run out of time, I do really want to hear about, so you mentioned Lisa Cook, Philip Jefferson, Adriana Kugler. I've been following the Fed for a long time. It's part of a misspent youth. I didn't do anything fun with it. Who are these folks?
We're in a very small club.
Who are these folks? Michelle Bowman is the hawk, right?
Michelle Bowman is clearly the hawk. Boy, talk about somebody we didn't hear from very often. Now we hear from her every other day.
But who are Phil Jefferson and Adriana Kugler? I have no idea.
So, if you're looking at a spectrum, it's interesting. Kugler's dissertation advisor was Janet Yellen's husband.
Oh.
At Berkeley.
Wow. I did not know that.
And so Kugler and Cook have both advocated for some of the most progressive monetary policy making in the history of at least American monetary policy making. It's much more resonant of what you might hear at the European Central Bank, for example. Philip Jefferson, his name has been bandied about as being a potential future chair, because he is seen as being somebody who is in the middle and balanced in his approach and balanced in his views, very articulate, soft-spoken. The irony here is, of course, that when I was leaving the Fed and I was following Richard Fisher, the president of the Dallas Fed, when I worked for him, the irony here is that he asked me at the time in 2015 to pay close attention to one of his close friends by the name of Jerome Powell. And I said at the time, well, it's hard to pay attention to somebody who barely talks and is so quiet. And I would point out that there's that similarity between Jefferson of today and Jay Powell of 2015. So he might be one we want to pay close attention to.
Well, I wish I could talk to you for I think hours, but unfortunately we're just about out of time. Thank you so much for joining us, and I hope at some stage we may get you back on the show again.
I would certainly enjoy that.
Thank you so much for all the insights.
Thank you for having me.